Welcome back to the Deep Dive. If you've been keeping an eye on the Indian markets lately, you'll know things have been, well, pretty wild.
That's putting it mildly.
Yeah, the main indices, Nifty 50, Nifty Bank, they've gone from record highs to some serious caution signs, almost in the blink of an eye. We're really deep diving into a volatile situation today.
Indeed. And, just relying on gut feeling, that won't cut it when the market swings this fast.
Absolutely not.
So our mission today is basically to bring together two key pieces for you. First, we're unpacking this detailed historical technical analysis. It covers the trends from, April 2022 right up to mid-2024.
Okay.
And second, we're layering that history onto what's happening right now. A real-time forecast for the trading week that starts September 29th, 2025.
So you get the full picture, history plus the immediate future.
Exactly. The idea is to give you a complete data-driven view of market health, the risks involved, and where the opportunities might be right now.
That sets it up perfectly. Usually when people talk investing, it's all fundamental analysis, right? Company earnings, economic health, trying to predict the future. But today, our focus is strictly technical analysis. We're looking at price action, volume, sentiment, what the charts are telling us now.
Precisely. Technical analysis is all about using patterns, indicators. It's like diagnosing the market's current mood.
Okay.
And the sources we're digging into, they rely on a core set of tools. We'll be talking about EMAs, exponential moving averages, to see the trend direction.
Right, smoothing out the noise.
Yeah. And the RSI, the relative strength index, for momentum, plus MED for confirming shifts.
And candlestick patterns, too. They tell a story.
Oh, definitely. The visual storytelling of candlesticks is crucial.
Right. Okay, let's start with the foundation then. Using that historical data, April 22 to July 24. Before this recent sharp downturn, what were the long-term technicals saying? How healthy were Nifty 50 and Nifty Bank?
The picture back then was, pretty strong, robust, really. Both indices were in a solid bullish trend.
When did those start?
Nifty 50 had been climbing steadily since about May 2023, and Nifty Bank joined in from December 2023.
Okay.
And the key signal for this momentum, it was how the price was behaving relative to those EMAs we mentioned.
The moving averages.
Yes, the prices were consistently trading well above the short-term 20-day, the mid-term 50-day, and the long-term 89-day averages. That's like textbook definition of a healthy upward trending market.
Sounds like a powerful trend. But, long trends often hit a point where they run out of steam. Let's talk about when the sources first flagged danger. By July 5th, 2024, what numbers were shouting extreme pressure?
Ah, that warning shot. It came straight from the 14-day relative strength index, the RSI.
Right, the momentum indicator.
Exactly. And remember, anything above 70 on the RSI is generally seen as overbought. It suggests the rally might be getting ahead of itself.
So what were the readings?
On July 5th, Nifty Bank hit 72.54, and Nifty 50 was even higher, 74.44. Those are pretty high figures, alarmingly so, you could say.
So basically the market was running too hot. Historically, what happens after readings like that?
Well, that's just it. Those high RSI readings back in July 24, they turned out to be quite prophetic.
Right.
They strongly suggested potential overvaluation, a high risk of a market correction. It was a signal for long-term investors to maybe think about selling or at least taking some profits off the table.
And the correction came.
It did, but it was slow at first. That pressure just sort of built up over the following months until, bam, September 2025 hit with a real shock.
Okay, let's pivot then. Let's talk about right now, late September 2025. The market didn't just cool off gently, did it? It shifted hard into bearish territory.
Yeah.
Just
right.
how bad was the drop leading into this week we're focused on, the one starting the 29th?
Oh, it was a significant breakdown. Really sharp. The Nifty index. It lost 672 points just last week.
Wow.
And what really stands out for technical analysts is the visual. Nifty printed 7 consecutive red candlesticks.
7 days in a row closing lower than the open.
Exactly. 7 straight days. That screams sustained, intense selling pressure. Sentiment has clearly weakened severely.
And technically, where does it stand versus those EMAs now?
That's the other key point. Nifty is now trading below both its crucial 20-day and 50-day EMAs. That's a major sign of short to midterm technical weakness. The trend has shifted.
Right. Okay, let's shift from momentum to risk. We often talk about Nifty 50 and Nifty Bank together. How tightly linked are they really? And what do the stats say about their risk profiles?
It's actually quite interesting when you look at their statistical relationship over that longer study period.
Yeah.
We found a moderate positive correlation. The number was 0.569 between their RSI values, meaning they tend to move in the same general direction, which makes sense. Same economy, right?
Okay.
But they're not perfectly in sync. One doesn't always perfectly mirror the other.
And the sources also mention an ANOVA test. For listeners maybe less familiar with stats, what does that tell us here?
Right, ANOVA analysis of variance. It basically looks at the swings, the volatility within the data sets. Are they similar? Okay. And the test confirmed, yes, both indices show a statistically similar level of volatility in their RSI movements.
So in simpler terms,
it means when Nifty 50's momentum gets volatile, Nifty Bank's momentum tends to swing just about as hard. Even if the actual price points aren't identical, the intensity of the momentum swings is similar.
Got it. So related movements, similar swing severity, but the actual risk-return profiles are different. Can you break that down using the coefficient of variation, the CV?
Absolutely. The CV is super useful for investors, I think.
Why is that?
It's basically risk, the standard deviation, divided by the return. So it answers the question, how much volatility, how much bumpiness am I accepting for every bit of return I get? It's all about efficiency.
Makes sense.
So in the study, Nifty 50 actually offered a slightly higher average return, 58.80 versus 57.54 for Nifty Bank.
Okay, slightly better return.
But, and this is the key part, look at the CV. Nifty 50 CV was higher, 16.89%. Nifty Bank, much lower CV, 12.28%.
So Nifty Bank was more stable, more efficient.
Exactly. Historically, it gave you a much better risk-adjusted return. You experienced less instability, less volatility to achieve its performance compared to Nifty 50.
Hang on, that seems a bit counterintuitive. Bank Nifty tracks financials, right?
Yeah.
That sector feels like it should be more sensitive to regulations, economic cycles. How do the sources explain Bank Nifty being statistically less volatile?
That's a really sharp observation. It comes down partly to what's in the index.
The composition.
Yeah. While individual financial stocks can be volatile, the Bank Nifty index itself is heavily weighted towards large, well-established, often quite diversified private banks and big financial institutions.
Okay.
These giants often have lower systemic risk compared to, say, a smaller tech company or a niche pharma firm. So that composition gives it a kind of structural stability you might not find elsewhere.
That clarifies things. Okay, let's add beta to the mix. The sources give beta 2 figures. Can you define beta quickly? And what do those numbers, 0.801 for Nifty 50 and 0.405 for Nifty Bank, tell us about sensitivity?
Sure. Beta measures sensitivity, specifically how much an index or stock tends to move compared to the overall market. A beta of 1 means it moves perfectly in line with the market.
Got it.
So these beta 2 figures show their sensitivity relative to the broader market trend. Nifty 50, with a beta 2 of 0.801, moved a bit less than the overall market. Its movements were slightly muted.
And Nifty Bank?
Significantly less sensitive. Its beta 2 was much lower, only 0.405.
Wow, that's quite low.
It really is. And it confirms what the CV suggested. Nifty Bank is less prone to getting tossed around by general market waves. It tends to offer more stable returns when the broader market is choppy. It acts more like a dampener than a magnifier of market volatility.
Okay, let's bring all this back to the immediate future, the week starting September 29th. Given those steep drops, the 7 red candles, what's the current bias, and what are the absolutely critical levels traders need to watch?
Given all that technical damage we talked about, the immediate bias has to be sideways to bearish for both indices.
Caution is key.
Absolutely. Defense is the name of the game. Traders really need to respect these price levels.
So for Nifty, it closed around 24,654.
Right. Immediate resistance, the levels sellers might step in, are 24,750 and then 24,880. The approach here is likely sell on any rise towards those levels.
And on the downside, support.
Critical support is right at 24,500 if that level breaks. Well, the major downside target becomes the 200-day EMA, which is sitting around 24,400.
The 200-day is a big one.
It's huge, often seen as the last line of defense for the long-term trend.
And what about Bank Nifty? It seemed less volatile historically, but it's still under pressure now.
Definitely under pressure. It closed at 54,389. Immediate resistance is up at 54,900.
And support.
The key support is the big round number, 54,000. That's the level to watch very closely. If 54,000 breaks, the next likely stop could be 53,784, which is its own 200-day EMA.
So holding 54,000 is crucial for Bank Nifty.
Absolutely critical to prevent the bears from really taking control.
That lays out the technical map. But let's zoom out slightly. Why is everyone so nervous right now? What broader market cues are feeding this cautious mood?
Yeah, that's a good question. What's driving the psychology and the money flows? First, you can literally measure the fear using the India VIX.
The volatility index.
Right. It surged almost 6% recently, up to 11.425. When the VIX spikes, it means traders are paying more for protection. Risk perception is high.
Okay, fear is up. What about the money?
We're seeing huge outflows from foreign institutional investors, FIIs. They are persistently selling.
How much are we talking?
Well, for example, on September 25th, they sold a net of nearly 5,000 crore rupees. The next day, September 26th, another 5,700 crore, roughly.
Wow, that's massive selling pressure. Note, 1 crore equals 10 million rupees.
It's pure de-risking. Foreign money is looking for safer places globally right now.
So if FIRs are dumping that much stock, why hasn't the market fallen even further? What's stopping a complete collapse?
That's where the domestic players come in. Domestic institutional investors, DIIs, have really stepped up to the plate.
Buying what the FIIs are selling.
Pretty much absorbing it. On those same 2 days, DIIs bought a net of about 5,100 crore and 5,800 crore respectively.
So DII buying is cushioning the blow.
Exactly. It's providing crucial liquidity and support, preventing a free fall. But it means the market's internal structure is under a lot of stress, this constant tug of war between foreign sellers and domestic buyers.
Okay, besides money flows, there's also major news hitting specific sectors and regulations, right? Adding to the uncertainty. What are the key external factors listeners should keep an eye on?
Yeah, a couple of big ones. First, a huge shock to the pharma sector.
What happened there?
Pharma stocks dropped sharply, like nearly 8%, after the U.S. announced this massive 100% tariff on branded drug imports. It starts October 1st.
100% tariff.
Yeah. Generics are exempt, thankfully, but this puts immense pressure on any Indian pharma company that relies on exporting branded drugs to the U.S. and doesn't have manufacturing inside the U.S. It's a major supply chain headache.
Okay, that's big for pharma. What else?
Second, there's a potentially significant regulatory shift coming from SEBI, the Indian securities regulator. They're looking at changing how derivative position limits work.
How so?
Instead of just overall limits on brokers, they're thinking about moving to a new system based on slabs and delta.
Delta, the option Greek.
Exactly. Tying the limits to an option sensitivity to the underlying asset's price movement. It's a fundamental change in how risk might be managed in the futures and options market. Could have big implications.
Right. Any other broad economic signals?
And one more subtle but important signal about broader economic pressure. The RBI, India's central bank, they actually skipped buying U.S. dollars in July.
Skipped buying dollars. Why is that significant?
It was the first time they'd done that in over 10 years. It suggests the Indian rupee is under quite a bit of strain, and the RBI is prioritizing currency stability over building up foreign exchange reserves right now.
Okay, a lot of cross currents there. So since the immediate outlook is cautious, maybe sideways to bearish, potentially range-bound, let's talk strategy. What about approaches that actually like it when the market doesn't move much? Volatility selling.
Yes, this kind of environment is textbook for discussing strategies like short straddles and short strangles.
Okay.
These are known as delta neutral strategies. Basically, delta neutral means you set them up so you don't really care if the market drifts up a little or down a little. Your profit isn't direction dependent, initially at least.
So where does the profit come from?
It comes from time decay, that's called theta, or from a drop in implied volatility, which is vega. You're essentially betting that the market will stay relatively calm.
Let's quickly touch on those Greeks, theta, gamma, vega, for anyone less familiar. How do they work when you're selling options?
Right, the Greeks are just variables affecting the option's price. If you sell an option, you want its price to go down. So, theta is your best friend here. It represents time decay. Every day that passes, the option loses a little bit of its time value. And that loss for the buyer is profit for you, the seller.
Time's on your side.
Exactly. Vega relates to implied volatility. If market expectations of future swings calm down, volatility drops, the option price falls, and again, that's good for the seller.
And the risky one?
Gamma.
Gamma. Yeah, that's the enemy for an option seller. It measures how quickly your directional exposure, your delta, changes when the price moves. Short option positions have negative gamma. Meaning big, fast price moves are bad. They accelerate your losses very quickly. That's the risk you take for collecting the premium and benefiting from theta and potentially lower vega.
Got it. Theta good, gamma bad for the seller. So the short straddle versus the short strangle, what's the practical difference?
Okay, a short straddle. You sell both a call option and a put option with the exact same strike price, usually the one closest to the current market price, the at-the-money ATM strike.
Same strike. Right. Because the strikes are identical, you collect the maximum possible premium upfront. But you have the narrowest profit zone. Your ideal scenario is the market finishing exactly at that strike price when the options expire.
Less room for error. And the strangle.
The short strangle gives you more wiggle room. You still sell a call and a put, but at different strike prices, both typically out of the money OTM.
A wider range.
Yeah. You sell an OTM call above the market and an OTM put below the market. You collect less premium than the straddle, but the market can bounce around a bit more between your two strikes before the position starts losing money.
Okay, so trade-offs.
Yeah.
Based on the historical study on Nifty 50, which one actually performed better and why?
The study did a direct comparison, looking at long-term performance, but carefully excluding that crazy COVID period in March 2020, which was just too unusual.
Sensible. And the winner.
The finding was pretty clear. The short straddle came out on top. It achieved the highest Sharpe ratio, that measure of risk-adjusted return we talked about.
What were the numbers?
The straddle's Sharpe was 0.056. The short strangle was close behind at 0.050. And just for comparison, simply shorting Nifty futures was, well, terrible, with a Sharpe of well 0.143.
Interesting. Why did the straddle edge out the strangle on Nifty?
It seems to be because, historically, the Nifty index actually did tend to finish surprisingly often quite close to those ATM strike prices chosen for the straddle.
Really, it gravitates towards the middle.
Over the study period, yes. This tendency validated the core bet of the straddle, that the market often reverts to the mean, or at least doesn't stray too far, within the option's lifespan. Nifty's relatively lower volatility profile during that period favored the strategy with the tightest profit window but highest premium.
Fascinating. Okay, let's wrap this up. What are the absolute key takeaways for you, the listener, trying to navigate this volatile, kind of sideways to bearish market right now?
I think the big picture is this clear shift we've seen. We went from that long-term strength, remember the overbought RSI back in July 2024, to this state of immediate sharp weakness we see now in late September 2025. The bias right now is bearish. That means being disciplined, sticking rigidly to those support and resistance levels we outlined.
Defense first.
Absolutely. And remember the stats. Nifty Bank, despite tracking financials, has historically shown a more stable profile, lower beta, better CV than Nifty 50. So caution is definitely the word of the week.
All right. Before we go, let's leave you with one final thought to chew on this week, especially if you're considering these volatility selling strategies.
Yeah, think about this. If strategies like the short straddle rely so heavily on theta, that slow, steady drip of time decay to make money, and they have that dangerous negative gamma lurking, how often does the market actually need to stay calm? How many small winning days does it take to cover the potentially huge loss from just one unexpected massive market shock that gamma will amplify?
That really gets to the heart of the risk reward in volatility selling, something to definitely consider.